Hi, everybody. We are here today to go through analysis of financial cash flow analysis. And this lecture will basically contribute to basics of business finance, and it can be used for general knowledge as well. The resource book that we're using is Brigham and Houston's Fundamentals of Financial Management. The first thing that we're going to do is we're going to go through some theoretical foundations. And to do so, we've got about 10 different questions that we want to answer. And if we can answer these questions, it'll be a lot easier to understand the core concepts that we are dealing with. And so the first question that we have is, what four financial statements are contained in most annual reports? And the thing you need to know right off the bat is that the four financial statements contained in most annual reports are the balance sheet, you have the income statement, you also have the statement of retained earnings, and lastly, you have the statement of cash flows. And these are the four financial statements that you're going to find in almost any annual report all over the world. Our second question is, who are some of the basic users of financial statements and how do they use them? Okay, so normally what we want to do is we want to be able to divide our users into internal and external users. Okay, so internal users of financial statements and external users of financial statements. And so, of course, internal users are people within the company, within the corporation. So, for example, accountants are an excellent example of internal users, and accountants will translate physical quantities into numbers when they construct financial statements. That means that the numbers that are shown on balance sheets generally represent historical costs. And so this is one primary user. Another analyst from within the company could be tracking trends of cash flows within the corporation to understand where best to utilize resources. In terms of external users, we could have, for example, bankers and investors. So it's safe to say that bankers will use financial statements to make investment decisions, to make intelligent decisions about what firms to extend credit to, or investors will decide which firms to invest in. And similarly, if we come back over here, managers need financial statements to operate their business efficiently. And in terms of external users, we also have another category called taxing authorities. So you're talking about the Internal Revenue Services and the Federal Board of Revenue. So our taxing authorities will need them to assess taxes in a reasonable way. And so this is another area that you should know. The next question says, if a typical firm reports $20 million of retained earnings on its balance sheet, could its directors declare a $20 million cash dividend without having any qualms about what they're doing? This is interesting, because when a firm reports $20 million of retained earnings on its balance sheet, it's basically indicating that they were able to generate $20 million in earnings in terms of net income that they're going to plow back or reinvest back into the company. But should you be declaring a 20 million cash dividend? No, because the 20 million of retained earnings would probably not be held as cash. The retained earnings figure represents the reinvestment of earnings by the firm. So consequently, the $20 million reinvestment in all of the firm's asset, it should not be declared as a $20 million cash dividend. So just to remember, the answer to this question is no, you don't want to do that. Explain the following statement. While the balance sheet can be thought of as a snapshot of a firm's financial position at a point in time, the income statement reports on operations over a period of time. So it's safe to say that, yes, this statement is absolutely correct. And if we were to elaborate, basically, the balance sheet shows the firm's financial position on a specific date, for example, December 31st, 2023. It shows each account balance at that particular point in time. So when we look at the balance sheet, we're actually seeing a picture at one point in time, not over a consistent time frame. And so that becomes Now, on the other hand, the income statement reports on the firm's operations over a period of time. So this is also absolutely correct. So when we say that it reports it over a period of time, basically the sales figures reported on the income statement for the period ending, let's say December 31st, 2023 would represent the firm's sales over the period from January 1st, 2023 up until that ending date, December 31st, 2023. Next, when we say the financial statements are based on generally accepted accounting principles and are audited by CPA firms, therefore, do investors need to worry about the validity of those statements? Explain your answers. Now, the purpose of the audit is entirely different, and the purpose of an investor looking at the financial statements is very, very different. So essentially, investors need to be cautious. They need to be cautious when they review financial statements. So while companies are required to follow the generally accepted accounting principles, managers still have a lot of discretion when they decide how and when to report certain transactions. And this discretion is what we need to be cautious of. So consequently, two firms in exactly the same operating situation could report financial statements that convey very different impressions. So really, it's the impression of the financial statement that we're trying to gauge, not just the information. Some variations can stem from legitimate differences of opinion, and that's very, very possible because one organization may be looking at a situation differently than another organization in terms of their long-term perspective. In other cases, managers may choose to report numbers in a way that helps them present either higher earnings or more stable earnings over a period of time. So this could be dependent upon choice. And really, legally, as long as they follow generally accepted accounting principles, such actions are not illegal, but these differences make it harder for investors to compare companies and gauge their true performance. Okay, so this is where that information is necessary. Unfortunately, there have also been cases where managers overstepped the bounds and reported fraudulent statements, and therefore, indeed, a high number of high-profile executives have faced criminal charges because of their misleading accounting practices. All right, now we have to look at the next question. And this says, what is free cash flow? If you were an investor, why might you be more interested in free cash flow than net income? So free cash flow is the cash flow actually available for distribution to investors after the company has made all the investments in fixed assets, into, let's say, new products, and operating working capital. This is essentially necessary to sustain ongoing operations. And this can basically be defined as NOPAT minus, or the net operating profit after taxes, minus the amount of net investment in operating working capital and fixed assets necessary to sustain the business. And this is extremely important. This is the amount of money necessary to keep this business going. It is the most important measure of cash flows because it shows the exact amount available to all investors, whether they're stockholders, or debt holders. The value of a company's operations depend on expected future free cash flows. Therefore, managers make their companies more valuable by increasing their free cash flow. This is what will actually lend to value. Net income, on the other hand, reflects accounting profit, but not cash flow. So keep this in mind as you compare free cash flows to net income. This is purely an accounting measure, and this is a measure of the resources actually available. Therefore, investors ought to focus on cash flow rather than accounting profits. Now, The next question says, would it be possible for a company to report negative free cash flow and still be highly valued by investors? That is, could a negative free cash flow ever be a good thing in the eyes of investors? So yes, a negative free cash flow is not necessarily bad. So first and foremost, yes, it could be a good thing in the eyes of the investor because it depends on why the free cash flow was negative. If we can understand this, it would make more sense. So if free cash flow was negative because NOPAT, or net operating profit after tax, was negative, that's bad. Okay, so a negative NOPAT is actually a bad sign. We don't want that. And it suggests that the company is experiencing operating problems. Okay, however, many high growth companies have positive NOPAT. So essentially what you're looking for is a positive NOPAT. If this is happening, then that's good. That's not a problem for the investor. But we have resulting negative free cash flows even after a positive NOPAT because they must invest highly in operating assets to support rapid growth. So it's that growth that can be seen from the investing perspective. There's nothing wrong with the negative free cash flow if it results from a profitable growth. And so this is the situation that we need to understand. When we say what is meant by the following statement, our tax rates are progressive. Well, progressive tax rates basically means that as your taxable income increases, so does the rate of the tax. And this is done to ensure that only those that are earning additionally are going to be taxed additionally. And 3-9 says, what does double taxation of corporate income mean? Could income ever be subject to triple taxation? Explain your answer. Well, first and foremost, double taxation, if we look at double taxation refers to the fact that corporate income is subject to income tax. That's the first level of tax that we are subject to. We are subject to income tax. And then stockholders are subject to a further personal tax received on dividends. And so this means that that same earning is going to be charged tax twice. And that's what double taxation means. Income could even be subject to triple taxation. And this is very interesting because you might have popularly heard of double taxation, but triple taxation is not normally discussed. So triple taxation is possible. Therefore, companies that receive dividend income can exclude some of the dividends from its taxable income. And this provision in the tax code minimizes the amount of triple taxation that would otherwise occur. And that's something to keep in mind. Now, in 3-10, it says, how does the deductibility of interest and dividends by the paying corporation affect the choice of financing? That is the use of debt versus equity. Now, because interest is paid is tax deductible, but dividend payments are not. How do we know this? Well, when we look at the statement of our income statement, we have EBIT, or operating profit, minus our interest expense. And this is that financing cost, or that interest that we're talking about. We're left with EBT, that's taxable income. And from this, we deduct our tax expense to calculate our net income. The net income is where we deduct our dividends from. And so when we say that how does deductibility of interest and dividends by the paying corporation affect the choice of financing? Well, interest expenses are tax deductible because the interest paid is tax deductible, but dividend payments, because they're paid after the net income is declared, this is not tax deductible. So the after-tax cost of debt is lower than the after-tax cost of equity. This is your debt component here, and this is your equity component here. And this encourages the use of debt rather than the use of equity. This point is discussed in detail when we talk about cost of capital and capital structure and leverage. Now, that's all essentially for the theoretical aspects within this topic, but now we want to go into the quantitative aspects. And so for the quantitative aspects, the first question that we're looking at is 3-1. Again, we are still using Brigham and Houston's Fundamentals of Financial Management. And here the question says, Little Books Incorporated recently reported $3 million of net income. Its EBIT was $6 million and its tax rate was 40%. What was its interest expense? Now, they've been kind enough to give us a hint over here. It says, write out the headings for an income statement and fill in the known values, then divide the net 3 million of net income by tax to find the pre-tax income, etc. We're going to go ahead and go through this process step by step, so it's a little bit easier. Now, in terms of our known values, we know that net income is equal to $3 million. We know that EBIT is equal to $6 million. And we know that the tax rate is equal to 40%, but we don't know what the interest expense is. So what we want to do is we want to set up our income statement here, okay? We're going to do EBIT, we have our interest, then we have our EBT, and then we have our taxes, and then we get our net income. So if we start filling this out one by one, remember we've got our EBIT, 6 million is right here. We've got our net income, that's 3 million right here. Now, we don't know our taxes, but we do know our tax rate. Our tax rate is 40% over here. Okay, so capital T is equal to 40%. Sorry, we've already written that over here. And now we're going to start filling it in. So for the purposes of calculation, we know that to get from net income to EBT, okay, our formula is going to be equal to EBT equals to net income divided by 1 minus the tax rate. And this is basically reverse calculating from here. It's a net income of 3 million divided by 1 minus 0.40. So 3 million divided by 0.6, and that will give us an answer of 5 million. If we plug this into a calculator, we are going to get 5 million. So our EBT is equal to 5 million. Alternatively, if you want to cross-check that, you just calculate your tax expense. And the tax expense would be equal to EBT multiplied by the tax rate itself. So it's 5 million multiplied by 40%. And you get 2 million for that. And so logically speaking, 5 million minus 2 million equals to 3 million. That means you've cross-checked your answer over here. That is correct. Now, to get to interest, of course, we're just going to go one step up. If EBIT minus interest equals to EBT, that means logically speaking, interest will equal to EBIT minus EBT. EBIT is operating profit and EBT is taxable income. So to calculate our interest, our EBIT was 6 million and our EBT is 5 million. And that tells us that our interest expense is going to be $1 million. And that is our final answer. If you have any questions, please let me know. Drop a comment below. And let's move on. Okay. Now, question 3-2 says, Little Books Incorporated recently reported $3 million of net income. Its EBIT was $6 million and its tax rate was 40%. What was its interest expense? Once again, what we want to do is we want to follow the same methodology as before. Okay, we've got our EBIT and we have our net income. EBIT, yes, and we want to determine the necessary numbers here. My apologies, I entered in the same question twice. My document seems to be glitching. All right, let's see what's happened here. Okay, just one moment. Let's go ahead and fix this up. All right, my apologies. So we just fixed up 3-2. So 3-2 says, Pearson Brothers recently reported an EBITDA, or an earning before interest, tax, depreciation, amortization of $7.5 million and a net income of $1.8 million. Now, real quick, what I'm going to do is I'm going to generate, or I'm going to write a income statement format over here, starting with EBITDA. And so once we have EBITDA, we deduct from that our depreciation and amortization expense. From that, we get EBIT, or our operating profit. From that, we deduct our interest expense. And we're left with EBT, or taxable income, earning before taxes, or taxable income. From that, we deduct our tax expenses, and then we are left with our net income. Now, using this format, essentially what we want to do is we want to put in our relevant numbers. So 7.5 million in front of EBITDA, and then of course 1.8 million in front of our net income. And this basically tells us how many steps we need to calculate before we can reach our relevant answer. It had $2 million of interest expense. We've got 2 million in interest expense over here. And we have a corporate tax rate of 40%. I'm going to write a 40% in front of this so we know what to calculate with. And now we're going to take this step by step, going backwards. Remember, we're going from the bottom up in order to calculate a relevant number, which is what was its charge for depreciation and amortization. So going backwards, we want to first calculate EBT. To calculate EBT, the formula for this is net income divided by 1 minus the tax rate. So that's 1.8 million divided by 1 minus 0.40. And so our EBIT, once we plug this into a calculator, our EBIT, our EBT, earning before taxes, is going to equal to 3 million. So we're going to go ahead and plug that in there. Now, I like to get very, very comfortable and fill in all of my blanks here. So just to calculate our tax expense over here, I would put in my tax expense would be equal to 3 million. That's EBT multiplied by the tax rate of 40%. And so that gives me 1.2 million when I plug that into a calculator. So I'm going to put in 1.2 million over here. And just to cross-check, 3 million minus 1.2 million is equal to 1.8 million. So I know that I'm on the right track. Going back up one more step between EBIT, interest expense, and EBT. To calculate EBIT, I'm going to go ahead and take my interest expense to the other side. The negative will become a positive. So that means EBIT will equal to EBT plus interest expense. Okay, so EBT is 3 million and my interest expense is equal to 2 million. So 3 million plus 2 million gives me 5 million. Okay, so my EBIT is 5 million. Going back up one more step, if EBITDA minus depreciation amortization equals to EBIT, that means I'm going to take depreciation amortization to the other side. And so I'll have EBITDA minus EBIT will equal to depreciation and amortization expense. It's my EBITDA is 7.5 million and my EBIT is 5 million. So 7.5 million minus 5 million, we plug that into a calculator or do it in our heads. We get 2.5 million as our relevant depreciation and amortization expense. And this here is our final answer. That's 3-2. If you have any questions, please drop a comment below. All right, moving forward into 3-3. 3-3 says, in its most recent financial statements, Newhouse Incorporated reported $50 million of net income and $810 million of retained earnings. The previous retained earnings were 780 million. Okay, so we've got net income, we have retained earnings, and we have current retained earnings, and we have previous retained earnings. How much in dividends were paid to shareholders during the year? And assume that all dividends declared were actually paid. All right. Now, essentially, we know that the retained earnings for the beginning of the year plus net income throughout that entire year Just one moment. Net income throughout that year. Here we go. Minus our dividends paid are going to be equal to our retained earnings for the end of the year. Now, because we know this, we can plug in all of our values. So the retained earnings at the beginning of the year are essentially the same as the end of the previous year. So we've got 780 million for beginning of the year. Our net income is 50 million. So we're going to add 50 million into that. We don't know what our dividends were, so we're going to flip that over to the other side, big retained earnings over here. So we will leave that, in fact, for the moment mathematically. Retained earnings at the end of this year are 810 million. Taking dividends to the other side and bringing this retained earnings on this side, we get 780 million plus 50 million minus 810 million will equal to the amount of dividends that we've paid. Once we plug that into a calculator, we will get 20 million as our dividends. That's that. If you've got any questions, please drop a comment below. Now, the next question here says, which of the following actions are most likely to directly increase cash as shown on a firm's balance sheet? Explain and state the assumptions that underlie your answers. All right, let's flip this up a little bit so that we can actually analyze each statement individually. So we've got A, B, C, and D. All right, so the first statement is that a company issues $2 million of new common stock. Okay, so when we say this basically means that cash sale of common stock is a source of cash through financing activities. All right, so this is an ideal way to increase cash shown on the balance sheet. This is when you issue $2 million of new common stock. So this is one possible statement. When we say it buys new plant and equipment at a cost of $3 million, well, this statement is something that will actually decrease the amount of cash. So we're not going to consider this statement. When we consider statement C, it reports a large loss for the year. This too would actually decrease cash. Why? Because we've probably had a greater cash outflow than we have an inflow, okay? This is going to decrease the cash. This is going to decrease cash. This seems to be about the only statement. It increases the dividends paid on its common stock. Well, when we increase the payment, then that will also decrease our cash holding. That means the only possible statement is that it issues $2 million of new common stock. That's it. Remember, if you have any questions, please drop a comment below. 3-5. All right, now 3-5 says Computer World Incorporated paid out $22.5 million in total common dividend. Wow, that's a lot of dividends. Okay, $22.5 million in total common dividends and reported $278.9 million of retained earnings at year end. The prior year's retained earnings were $212.3 million. What was the net income? Assume all dividends declared were actually paid. So we don't know what our net income is. Now, one more time, remember that our formula says that our retained earnings for the beginning of the year plus net income for that year minus dividends will equal to retained earnings for the end of that particular year. What we want to do is we want to shuffle this formula around specifically for net income. So we're going to hold on to net income over here. We're going to shift the other two variables to the other side. So we have net income will equal to retained earnings for the end of the year. This has a positive sign on this side, so when it shifts over, it'll have a negative sign. So minus retained earnings for the beginning of the year. And this dividends has a negative sign, so when it shifts to the other side, it'll have a positive sign, so plus dividends. Now, we do have all three of these values, so that makes it a lot easier. Our retained earnings for the beginning of this year, for the end of this year, are $278.9 million. $278.9 million. Our retained earnings for the beginning of the year are essentially the prior year's retained earnings. That's $212.3 million. And our dividends during this particular point in time are $22.5 million. Okay, now when we plug all of this into a calculator, we will be left with $89.1 million. And that is the amount that we have in our net income. If you have any questions, please drop a comment below. All right, now the next question, 3-6. It says WC Cycling had $55,000 in cash at year-end 2007 and $25,000 in cash at year-end 2008. Cash flow from long-term investing activities totaled $250,000, and cash flow from financing activities totaled $170,000. Part A says, what was the cash flow from operating activities? All right, cash flow from operating activities. Just a moment. I'm going to go ahead and take a moment to separate this so that it's a little bit easier to do. Okay. What was cash flow from operating activities? Now, when we need to calculate cash flow from operating activities, the first step that we're going to do is determine what our cash in hand is. So what was the change in cash? To determine the change in cash, we're going to calculate the difference between cash at the beginning of the year minus our cash at the end of the year. My apologies. It should be cash at the end of the year minus cash at the beginning of the year. And so this is what will tell us what our change in cash flow was. So cash at the end of the year in this case is 55,000 year in 2007 and 25,000 year in 2008. So end of the year is 25,000 and beginning of the year is 55,000. This gives us a negative 30,000. So we've decreased our cash holdings throughout this year. That's the first thing that we understand from this. Now, this also means that the sum of all cash flows generated from operations, investment, and financing will equal to negative 30,000. That's why this number is important, okay? So cash flow from operations plus cash flow from investing plus cash flow from financing will all equal to negative $30,000. And here we know that cash flow from long-term investing activities totaled $250,000. That's $250,000 here. Cash flow from financing activities totaled $170,000. Cash flow from financing totaled $170,000. All of this should equal to minus 30,000. And so we can find out what cash flow from operating activities was on the basis of this. Let me just create a little bit of space over here for us to finish calculating this question. All right, now we want to take these two numbers to the other side. They're positives here, so they'll become negatives on the other side. And that basically means, just one moment. Total, this is a negative 170,000. My apologies. Negative 170,000. There's a problem with that sign over there. All right, so this basically means that if we were to calculate the differences on this particular side, we would be able to go ahead and flip that over to the other side. Investing activities normally have a negative sign, and our financing activities will always have a positive sign because you're receiving money in financing activities, but you're investing money. It's a cash outflow in your cash flow from investing activities. And so what we want to do is when we flip this over to the other side, the negative will become a positive and the positive will become a negative. That means our cash flow from operating activities will equal to negative 30,000. We already had this on the side. The negative 250,000 will become positive 250,000. And the positive 170,000 will become a negative 170,000. So negative 30 and negative 170 is 200, and 250 minus 200 will give us $50,000 in cash flow from operating activities. If you have any questions, please drop a comment below. All right, now this part is interesting because it says that if Accruals increased by $25,000, receivables and inventories increased by $100,000, and depreciation and amortization totaled $10,000. What was the firm's net income? All right. Now, we can connect this directly to what we understand from cash flow from operating activities. So if we were to write down the cash flow from operating activities, it would create a formula sort of like this, where essentially we're saying that net income, that's part of your cash flow, right? We add to that our depreciation amortization expense because that was your non-cash expense. We'd also add to that our increase in accrued liabilities because this is cash flow essentially that we've not had to spend right now. And from that, we would decrease our increase in our accounts receivable and inventory. Is this the amount of money that we essentially owe? And all of this is how we calculate our cash flow from operating activities. Now, technically, in this entire equation, we've been given accrued liabilities, we've been given receivables and inventories, we've been given depreciation, amortization. We already calculated our cash flow from operating activities up here, and so we need to calculate the net income. If we modify this formula according to the equation for net income, that would equal to cash flow from operating activities minus depreciation and amortization expense, because the positive will become a negative on the other side, again, minus increase in accrued liabilities, the positive will become a negative, and lastly, plus, because the negative will become a positive, plus increase in accounts receivable and inventories. And all of this would then, and this is essentially how we'd calculate our net income. Plugging in all of the numbers we know from the last part of the question, we know that cash flow from operating activities is 50,000. Our depreciation and amortization expense in this particular question is given to us as 10,000. So minus 10,000 minus increase in accrued liabilities, and that's 25,000. So minus 25,000 and plus increase in accounts receivable and inventories, that's 100,000. And so our net income, when we plug all of this into a calculator, is equal to $115,000. This is our net income. If you have any questions, please drop a comment below. In 3-7, now we have a slightly longer question over here, but this is useful because it allows us to calculate based on our financial statement. Okay, so now what we want to be able to calculate is our net working capital. We want to be able to calculate our free cash flows, and we want to be able to calculate the statement of stockholders' equity. Okay. All right, so now going step by step. What was net working capital for 2007 till 2000 and 2008? All right, so to calculate net working capital 2007 and 2008, we look at Bailey Corporation's financial statements. And working capital, of course, is the difference between our current assets and our non-interest charging current liabilities. Okay, 2007 and 2008's net working capital. So current assets and current liabilities. All right, now for current assets and current liabilities, we want to make sure that we can see 2007. All right. So essentially, when we're looking at the 2008 and 2007 statements, what we want to make sure when we're calculating our working capital is that we're looking at the right part of the statement, okay? So in order to calculate net working capital, first and foremost, That's for part A. And we're going to do this over here because we've got the information right over here. So to calculate, sorry, my apologies over here. So to calculate our net working capital, we're going to take our total current assets, and from that, we're going to deduct our total current liabilities. For 2007, that basically means that we're saying net working capital is current assets minus current liabilities. So for 2007, that means our current assets are 59,000 and our current liabilities, as you can see over here, where our current liabilities are 20,150. Okay, so when we deduct these two, we get $38,850 million, basically, because the statement is in millions of dollars. All right. Now, once we have the 2007 number, we can also calculate the 2008 number. So net working capital for 2008, again, is going to be equal to current assets minus current liabilities. And for 2008, our current assets are equal to 72,125. And on the other hand, our current liabilities are equal to 25,100. That means that our current net working capital for 2008 is equal to $47,025 million. So that's part A. We've been able to calculate the net working capital for 2007 and 2008. In part B, we want to see how to calculate Bailey's free cash flows for 2008. Now, when we want to do free cash flows, essentially free cash flow can be calculated as EBITDA minus taxes minus net investments in operating capital minus net investments in fixed capital. So let's go ahead and calculate all of these one by one. Okay, so first of all, we want to be able to calculate our net investments in operating capital. And the net investment in operating capital is going to be equal to the change in net working capital. So that's why we calculated the net working capital for 2008 and the net working capital for 2007. So the 2008 working capital of 47,025 minus our 2007 capital of 38,850, and this gives us a net investment in operating capital of $8,175 million. Now, this is our net investment in operating capital. Next, we want to calculate our net investment in fixed capital. And to calculate our fixed capital, we want to see the changes in our net plant and equipment. So net plant and equipment of 2008 minus net plant and equipment of 2007. Net plant equipment 2008 minus net plant equipment for 2007. 2008 is 50,000. And 2007 is 47,000. Okay, so that gives us 3,000 in net investment in fixed capital. We have two of our necessary values. So now basically we can calculate our FCF, because FCF will be equal to EBITDA minus our taxes that will come from our income statement, minus net investment in operating capital, minus net investment in fixed capital. So this is sort of another way of looking at free cash flows. And so if we look down at our statement over here, our EBITDA is 44,000. So we've got 44,000. From this, we're going to deduct our taxes. Taxes are 14,900. And then we have our net investment in operating capital, which we calculated over here. So that's 8,175, and net investment in fixed capital, that's 3,000. When we put all of this into a calculator, we get $18,925 million. And this is equal to our free cash flow. So all three parts of this question are done. Sorry, two parts of this question are done. The third part says construct Bailey's 2008 statement of stockholders' equity. We're going to do that down here because we need a little bit more space. So the statement of stockholders' equity. Now this is going to basically show us, sorry, just a moment. Statement of stockholders' equity is going to show us changes in common stock, retained earnings, and any additional adjustments that are affecting equity. So we already know that we have our equity here for 2007 and 2008. So the first thing that we want to do is we want to calculate the first thing that we want to do is we want to calculate our common equity. In fact, the specific values that we'll go ahead with is to calculate our stockholders' equity is going to be our beginning equity, and specifically beginning common equity. And this is going to be the equity from 2007. So we come back up over here, and from 2007, our common equity was 70,850. So we've got 70,850. And to this, we are going to add in our net income for this particular year, for 2008. So we look up at our statement, and our net income for 2008 is 22,350. So we put in 22,350. And from this, we deduct our dividends. So our dividends are 11,000 from over here, 11,175. So 70,850 plus 22,350 minus 11,175. This will give us our ending common equity. And this number must match with the 2008 equity on our balance sheet. So if we put this into a calculator, we are going to get 82,025. And if we look up over here, there we go, 82,025. Once again, these three parts are done. So if you have any questions, please comment below. All right. Now, moving forward, we basically want to be able to calculate, in 3-8 as a brand new income statement. Okay, now to do so, we're going to see what they've given us. Herman Industries is forecasting the following income statement. The CEO would like to see higher sales and a forecasted net income of $2.5 million. That means that this number over here is going to be $2.5 million. Assume that operating costs, excluding depreciation and amortization, are 55% of sales. This is a critical piece of information. And the depreciation, amortization, and interest expenses will increase by 10%. So both of these expenses are going to increase by 10%. The tax rate is 40%, which will remain the same. What level of sales would generate 2.5 million in net income? So we've got to calculate a new level of sales. And what we're going to do over here is we're going to go step by step and reverse calculate. And we've already done a bit of this up until EBITDA, so it's essentially just one new step here. Okay, so let's take it one by one. Going up from net income to EBT, or taxable income. So we know that in order to calculate this, we're going to take our EBT, and we are going to divide it, our new net income, and we're going to divide it, so 2.5 million, and we're going to divide it by 1 minus the tax rate, 1.1 minus 0.4. When we plug this into a calculator, basically we are going to get, sorry, just one moment. In fact, let me go ahead and put that a little bit to the side so that I can construct a new statement over here. Okay, I'm going to write on top of this so that it's a little bit clearer in terms of alignment. We're left with the other space for our work, essentially. Just one moment, bear with me. And then we can do our rough work over here on the side. Okay, there we go. So now to calculate our new EBT, we're going to take our net income of 2.5 million. And we're going to divide by 1 minus 0.4, 1 minus the tax rate. And that is going to give us, when we plug that into a calculator, we are going to get 4,166,667. That's 666.67. But for the sake of simplicity, we're going to round off to whole numbers. If you are interested in calculating the tax expense so that you have the complete income statement, you'll simply take 4,166,667. You'll multiply that by 0.4. When you plug that into a calculator, you'll find the tax expense is 1,666,667. Okay, and so this is, again, cross-check mathematically. So EBT minus taxes will equal 2.5 million. That means both of these numbers are correct so far. All right, now let's go up to interest expense. Over here, they said that interest expense will increase by 10%. So essentially, we want to take 600,000, we want to multiply that by 1.10, 1 representing the original and the 0.10 representing the 10% increase. That'll give us 660,000 when we plug that into a calculator. Going up to EBIT, to calculate EBIT, we'll take interest over to the other side. So that means that we'll have EBT plus interest, so 2,200,000 plus 600,000, and that will give us our EBT. My apologies, I was using the old numbers. I need to use my new numbers over here from the ones that I was calculating for this particular question. And so our EBT is 4,166,667, and we want to add into that 660,000, these two new numbers over here. When we add this, when we plug that into our calculator, we get 4,826,667, and that is our EBIT. Once again, at depreciation and amortization, the statement over here says the depreciation and amortization will increase by 10%. So 800,000 multiplied by 1.10 will give us 880,000. Well, up one more step to calculate EBITDA, we're going to take EBIT plus depreciation and amortization. So that's 4,826,667 plus 880,000. And when we plug that into a calculator, our EBITDA is going to be equal to 5,706,667. Now, to calculate operating costs, we've been told that operating costs are 55% of sales. So to reverse calculate, this would be basically to take our this would basically be to take our EBITDA, 5,706,667, and to divide that by 1 minus 0.55. And this is the same logic that we applied right over here to calculate our EBT. So it's the same method that we can apply to calculate our sales. And in order to, and so that basically means that our calculation here is 12,681,482. Now that you have your sales, you can again calculate your operating costs. So your operating costs, the calculation for this point over here, your operating costs are going to be equal to 12,681,482 minus 5,706,667. And once we calculate that, we are going to get 6,974,815. So now you've been able to recalculate the entire new income statement. And so the answer to the question, what level of sales would generate 2.5 million in net income? The answer to that is sales of 12,681,482, and it's done entirely by reverse calculating your income statement. If you have any questions, please drop a comment below.